Hello, this is Dr. Flight, and this will be a lecture on some pricing strategies that you can consider as your product goes through the product life cycle. So the product life cycle has a various 4, 5, 6 different stages. And during those stages, it's appropriate to change a price and use a different pricing philosophy depending on the market and the degree of competition and how much volume you have. And then also, while you're managing price, you're also managing costs and margin as well. Okay, so this will be a video then that deals with the different product life cycles and different strategies that you can use as a firm when it comes to pricing moving forward through the product life cycle. Alrighty, let's go ahead and begin with the review of the product life cycle. And so if you'll recall, the product life cycle goes through four major stages, and in this chart we actually have 5. We include the late growth stage as one of the stages. You can think of early market as the introduction stage. There's also a stage in here that focuses on the, it's called the shakeout period. But regardless, you should be familiar with the product life cycle and the different stages that happen. And this chart or this curve is measured as market demand, or sometimes referred to as sales, over time. So we chart sales within an industry over a period of time, and then that's how we get this. The other thing is, or two other things that we will look at just as we start here and we look at the product life cycle curve. The idea that as we progress through time, different the customers vary. So during the early introduction stage, for instance, we have innovators who are then followed by early adopters. Then we get into the late growth stage and early majority stage, and we have early majority customers and late majority customers. And then finally in the decline stage, we have people who are called laggards. And so there are 5 different consumer characteristics that happen while this is taking place. And of course, as we price, we need to think of the characteristics of those consumers. The other thing that we need to do is consider the competition that we face during these various stages as well. So very early on in the product life cycle, we often do not have a lot of competition, because if we're the late leader or the innovator, we're making the market, and other competitors just simply aren't quite in it yet. However, once the product begins to take off and into the growth stage, we have a lot more fierce competitors who come in, and they really cause us problems all the way through till the top of the maturity period. So during the maturity and late maturity period, we deal with competitors all the way through. So pricing then through the product life cycle deals with managing the expectations and the sales within the market, and also keeping in mind that we have competitive pressures happening simultaneously. So the skimming price strategy then would be one strategy that a firm could use, and this would be by the leader, by the innovator. The skim pricing strategy requires you to set a high price, since the volume of sales will naturally be low because the product is just beginning to take off and you're targeting the innovators who would buy your product. So innovators are less price sensitive. They're willing to pay more for the product, and since volume is low, we need to make margin, or we want to make a margin we want to make profit that's high enough, so we set a higher margin by pricing the product up high. So as you can imagine, as the market becomes more penetrated, you get customers that are more price sensitive. So after the introduction stage, after the skimming price strategy, you'll need to lower your price over time, just to account for changes in the market. And in addition, right now, as you're in the introduction stage, you probably don't have a lot of competition. And so you don't have that competitive pressure to lower your price quite yet either. So lack of competition, you can behave like a monopolist. The consumers are less price sensitive, and so this allows you to price high and have a higher margin. Even though your overall volume is lower, your goal right now is to recoup research and development costs and to make this a profitable product. So then what we do is we move into the single segment pricing strategy. And as we move into this strategy, what we're doing is identifying a core group of consumers. So we're out of the introduction and innovator stage, which makes up about 2.5 to 5% of your market. This next stage of early adopters is the beginning of the growth stage, and so we're easing out of introduction, but the market hasn't been fully developed yet. It's still growing, so it's not completely well defined. There's probably a competitor or two who's come into the market industry, and they may have a competing technology, and so we're fighting that off. We're defending our technology and our brand, if you will. We're still establishing a reputation, but we definitely have a broader audience than we had as the innovators purchase and the early adopters begin. So it's not a large enough market to be considered a mass market yet. It's still small enough to focus on. However, we're clearly defining ourselves as a option as opposed to the only option. We're defining ourselves in respect to potential competitors who are around us at this particular time. So up to this point, we've had the skimming price strategy and then the single pricing strategy, which leads us into penetration pricing. So penetration pricing is a deviation from a skim price strategy. In fact, some would say it's probably the opposite, where in this case, what we're going to do is lower our price so that it's attractive to a mass market. So it's a mass marketing strategy where we want to be appealing in price to a wide variety of consumers, as opposed to only the price, the ones that were non-price sensitive, the innovators early on, like our skim price strategy. We're really lowering our price so that we're appealing to a huge market or audience. So we want to increase volumes of sales, and so this happens when the market is large enough. So we're probably entering we're definitely in the growth stage. We have increasing volumes of sales that are continuing. The market's expanding. We're really focused on a lower price, and as we're doing this, we are in part doing it because of reflected changes in the market, but also we have a lot more competition. So we want to gain market share. We want to grow market share and volumes of customers as the market grows. The other element here is just thinking about gaining customers. If you can gain customers in a growing market, then when the market slows down, those customers, if you treat them right, will remain loyal. And so you want to be able to gain as many actual individual customers as you can now, so that you can turn them into loyal customers, and they'll be repeat customers later on down the road. So this penetration pricing strategy then is one where you're growing business, and it really leads us now into the low cost leader pricing strategy. Now, the low-cost leader pricing strategy is somewhat interesting because the technology and the product itself is not new anymore. It's a product that people are familiar with. It's been developed and marketed to a mass audience. But one of the key features here is from a business model perspective, we want to start lowering our costs if possible to become more efficient and to gain sales margin. Now, a low-cost approach means that the firm is spending less to produce the product, probably on sales volume and other efficiencies that are gained from volume. But the lower cost per unit that the firm is achieving does not necessarily mean a lower price for the consumer. It may in fact mean that the firm is lowering their costs of operations, and then they can take that higher margin that they're earning and they can invest in defensive positioning. So they can take that additional revenue from margin and they can use that revenue to maybe develop their distribution channels or do some more aggressive advertising or other elements that will secure their position in the marketplace and defend themselves from competitors' interests. So if the firm can take those margins and they can take a greater stake in downstream like distributors and retailers, if they can invest in those, if they can invest in suppliers and things like that, if they can upgrade their factories and their production, maybe they even go out and buy a trucking company so that they can manage that process. They can do all those types of things. They may take that money and move into a multi-segment pricing strategy, which would be next. But in order to do that, they would probably need to develop a few more versions of their product, which again is an investment in a defensive position and developing new ways to sell products to existing customers. So as we move into that multi-segment pricing strategy, what we're doing is we're beginning to define customers in new and different ways. So we're finding better ways to solve customer needs because we're recognizing that not all customers are the same. And we're realizing that a single segment pricing strategy or even a mass marketing pricing strategy, which we've used in the past here, that's not sufficient because consumers want products that are uniquely made for them at this point in the product life cycle. So each segment here that we've identified, and in this case we have an example from General Electric, who has two different market segments. They have a market segment that needs a long-term solution, or they want a long-term solution, and so they're not very price sensitive in this particular case. They're if we look at this, just the way this curve is sloped downward, that would suggest an inelastic type of a pricing sensitivity. So there's one market here, and then there's another market segment that's very price sensitive that would be willing to have a shorter term solution as opposed to a longer term solution. So now the market's large enough and there's enough competition out there where there are special segments that are that can be developed, maybe not in traditional terms, but in this case by price sensitivity and by maybe the longevity of their purchases and their purchase history, something along those lines. So what GE would do in this particular case is they would develop a marketing plan for this market, which would include a specific product at a price with a marketing plan associated with it. And then they would do a second marketing plan that's targeting the second market as well, and make an effort to treat both markets separately and penetrate both markets as they can. So this will continue to fuel growth. This will continue to, give the firm a presence in a growing sense and define the brand in a better way. And this actually is one of these strategies that actively leverages brand equity at this point. So, the positive image that customers have of the brand can actually help a firm do this better, do a multi-segment strategy even better and more effectively. Okay, the last few strategies here, there'll be 3, and they all happen towards the top or the end of the product life cycle. Okay, so a +1 pricing strategy is one where you match your competitors. You match your competitors like products and features, but then you give an additional reason to buy for the customers. So you provide an additional, more compelling reason to buy, in addition to meeting the expectations that the customers have of this product category. You add other elements. So this is also a differentiation strategy in terms of what you're doing. At this point, the product's becoming a commodity. It's like it's not new. It's an old product. It's been around for a while, and customers kind of know what it's all about. And so now you're compelled to give them an additional reason to buy your product above and beyond the normal value proposition that one would associate with the product that's here. So the idea that the product's commoditizing and that you have to differentiate yourself gives you a reason to price a little bit differently here. So you give a product and then you add a service, and that's the justification for the sale of the price or the sales price that's offered. So you're providing better value in this pricing kind of area here. You may add price, you may go up in price a little bit to justify this additional benefit or something along those lines. The next step or the following area here would be a reduced focused pricing. A reduced focus pricing is one where you again continue to push additional benefits onto the customer, and what you might actually call this as a reduced focused pricing strategy is a selective pricing strategy. So this pricing strategy is a little bit different. You might think it a little counterintuitive, but at this point the market's pretty well saturated. So there's a lot of customers who are buying the product, relative to those who haven't. And at this point, you're not looking as much for sales growth in terms of volume, but you're looking to maintain and hold on to margin and even increase margin as volume begins to go down. So when you say reduced focus, what it really is you're not focusing on price so much, but other features, and you can raise your price even a little bit in order to capture that. So here's a case. In fact, if you look at the current price strategy of this particular firm and the reduced focus pricing strategy, across there, they've got 5 different products that they highlight here. And if we just look at this overall total column, look at the price per unit average. In their typical strategy, they charge $1.46, but in their reduced focus strategy, they're charging $1.85 on average per unit. So they're actually increasing their margin by increasing price, but they're at a special point in the product life cycle curve where customers who are loyal, customers who know the product, customers who believe in their brand because of the brand equity they have, that they're willing to continue to buy even though the price is raised a little bit. And in fact, the percent change in price increase is greater than the percent change in sales decrease. So what the net result will be an actual increase in net marketing contribution. Costs per unit go up a little bit because you're dealing with a slightly smaller volume and you're losing some of your volume discounts. So price per unit goes up, so costs go up a little bit, but they don't go up as much as your revenue does, and your sales don't drop as much. So market demand here, in fact, in this case, is similar, but your sales, your marketing share goes down because your price went up. So you're actually going to sell fewer units, so 92.1 probably million units as opposed to 125 million units. It looks like that's the drop in demand, but again, you're playing off this idea of price inelasticity and that customers are still willing to buy the product. So this continues on. So we have this idea before where we had this plus one pricing strategy where you're really kind of looking at quality over quantity. And then this is even more so the case here with a reduced focus or a selective pricing strategy where you're really narrowing in on those customers that are least price sensitive and the ones that are maybe even better customers for you. The final step here, the final stage, is the harvest pricing strategy. And I think one of the big takeaways with the harvest pricing strategy is that you're not lowering your price necessarily here just because you want to liquidate the product and get rid of it. What you're doing is you're lowering your costs. That's the big emphasis on harvest pricing, is you don't necessarily lower your price, although you may, but you could actually keep your price the same or increase your price to again continue that selective pricing strategy that you've been doing. But the key here is, the reality is your goal is to lower costs, and when you lower costs, what I mean is you're not spending as much money on product development, on product maintenance. You're not spending as much money on advertising or distribution or any of the other marketing functions that you normally would be doing. You're essentially not investing any more in the product and letting the current market just buy and run itself out, run its course. So you're actually making money and you're making margin, even though your sales numbers are dropping. You're making margin because you're lowering your costs, and you may simultaneously be raising prices or keeping prices the same at any rate at that particular time. Okay, so this video then talks about stages of the product life cycle, and I really want you just to remember that the way we price through the product life cycle is a reflection of the type of customers that we have and the competition that we have, and the balancing of margin versus volume throughout the product life cycle. So there's 8 different pricing strategies that are talked about. It goes from the skimming price strategy to a single segment strategy, penetration strategy, low-cost leader strategy, multi-segment, and then it goes into the decline and maturity strategies, the +1, reduced focus, and the harvest. Okay, so please touch base with me. Let me know if you have any questions. Thank you very much for your time and listening.